Hi, today we're going to discuss mutual funds versus ETFs. We'll cover the history, the background, some of the costs associated with each. So the first mutual fund was started, we think, in 1774 by a Dutch merchant. The objective is to minimize cost while providing great diversity. So what would happen is a group of investors would pool their money together. They'd buy individual investments. They would sum up the total on a daily basis and distribute capital gains. That's the modern mutual fund. So the first U.S. mutual fund that's still in existence is the Vanguard Wellington. It started in 1929. Okay, so it's been around a long time. Mutual funds have a tremendous amount of assets under management in the U.S. and across the world. Two concepts that we've previously discussed in these videos is active versus passive. Mutual funds tend to be actively managed, whereas ETFs tend to be passively managed. Passively managed means lower costs. So one of the structural advantages ETFs have going for them is a lower cost advantage. Second, we'll talk about how they're traded. So a mutual fund is traded at the end of the market based upon the net asset value of the underlying investments. Okay. ETFs, on the other hand, trade throughout the day like a stock. So you can move in and out, in and out. So it provides a little bit more flexibility from there. On the other hand, the downside is, upside is flexibility, downside is the pricing during disrupted markets can sometimes become dislocated from reality. I don't think it happens for long, but it can happen. Mutual funds are based on the net asset value of the underlying investments. Okay. From a tax perspective, if you make an investment in either one of these investments and it goes up in value, the ETF does not distribute capital gains. However, the mutual fund does do capital gains distribution, usually on an annual or semi-annual basis. So it can be a little bit more tax efficient to go with an ETF. Okay. From a cost perspective, so typically the mutual funds have been burdened with a little bit more costs. Sometimes they have loads up to, you can see some funds with 3, 4, 5% load. It's mostly dissipating now, but historically there's loads, and then there's a trading fee. So the America's brokerage firms, the TD Ameritrades and Schwab's and Fidelities, ETFs trade for free now. Mostly, not always, but a lot of times they trade for free. And the mutual funds will have a transaction costs associated with it. That's one. So you have a tax benefit for the ETF. You have a lower cost for the trading. That's two. And then from a management fee perspective, mutual funds have a 12B-1 fee, which is the management fee. So you can think of a mutual fund. They're going to have analysts and managers and travel because they're going around the world investigating all these different companies to come out with the best value for the underlying investor. Whereas ETFs are doing the passive routine, where they're just matching this index, whatever the index. There's hundreds of indexes, so they're just matching that index, and it tends to lower the overall costs. The mutual fund industry is not sitting around whenever the ETFs have been growing like this since the Great Depression, Great Recession. The inflows have been tremendous, and mutual funds are still larger and hold more assets. But so to be competitive, they've dropped their costs. They're reducing the loads. They're reducing the transaction charges. So we're seeing a lot more of a level playing field. But ultimately, what the objective is to provide more value to the individual investor, more benefits, more options. So this is just a continuing evolution of products designed to provide you, the ultimate investor, with more value at a better price point. And mutual funds went a huge way toward democratizing investing for the small investor. ETFs are a parallel investment option that provide even lower costs. Some cases the costs are exactly the same, so that doesn't necessarily. A modern ETF and a modern mutual fund can be very similar, but you need to do your due diligence, understand what your investments are, what the costs are, what the tax implications are. Anyway, so this has been an overview of mutual funds and ETFs, and I'd like to say thank you for watching.